Good afternoon, students. In this class, I will discuss about portfolio evaluation. Actually, it is a chapter about to discuss about the performance of the mutual funds. Before discuss going into discussion, you must have to understand what is mutual fund. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income from the funds of investors. Okay, so mutual fund, as we know, if we want to earn from either from stock or mutual funds, these are not risk free investments. Risk automatically associated with these type of investments. Therefore, the return is best calculated in this way. You cannot alone calculate the return of the mutual funds. Rather, we have to calculate the risk adjusted returns, and the returns is basically depend on the NAV. What is NAV? NAV is at actually net asset value. Net asset value is the value of funds assets minus its liabilities. NAV is typically calculated on a par and on a par unit basis. Sorry, net asset value of the value of funds. Net asset value is the value of a fund's assets minus net asset value is the value of a fund's assets minus its liabilities. NAV is typically calculated on a per unit basis. NAV is equal to market value of all securities held by the fund plus cash and equivalent holdings minus fund liabilities divided by total fund units outstanding. Outstanding here means the number of units held. As we look for the example, if a mutual fund holds rupees 205 lakh worth of securities and 30 lakhs cash and rupees 6 lakhs of liabilities and 20 lakh units outstanding at the close of a trading day, then the value is computed as given below. NAV equal to, if you calculate 2 lakh 5 205 lakh plus 30 lakhs minus 6 lakh divided by 20 lakhs, that equals to 11.45. Students, you must have to remember the return of the fund is totally dependent on NAV, and NAV and return, they are positively correlated. We can say in this way, if NAV increases, return increases. If NAV decreases, automatically return decreases. They are moving in the same direction. They are moving in the, because as we know, when we are calculating the return, what is the formula? Closing value minus opening value divided by opening value into 100 in terms of percentage. That's why the return and NAV, they are positively correlated. Now, as I have told you earlier, the return from mutual funds should not be calculated alone by its return. It should be risk adjusted return. There are so many measures, but for the BCom students and for the general students, we must have to calculate Sharpe performance index. Look at the formula. What is the formula? RP minus RA by sigma P. RP means the return from the portfolio, return from the fund. RF we already know, that is risk free return, and sigma P is the standard deviation of the portfolio return. Then is actually Sharpe ratio, but we should not calculate it over here. Then we move on to the Treynor ratio. In case of Treynor ratio, the formula is like that. What is the formula? Rp minus Ra by beta p. If we look into the formula, the numerator is same both in case of Sharpe and Treynor, but the denominator is different. Earlier the denominator was sigma p, now it is beta p, beta of the portfolio. What is beta? As we know, beta measures the systematic risk or uncontrollable risk or risk of the market. Next is Jensen performance index. Jensen performance index, the formula is like that. Rp minus alpha plus beta into Rm minus Rf. What is Rp? Rp actually the return from the average return from the portfolio or return from the market. What is Rf? Risk free return. Alpha is the intercept, actually it is the intercept. Beta, as we know, measure of systematic risk, and Rm is average market return or market return. Okay, understood. These are the three formulas. Now we straight away move on to the sums. Look at this. Look at this question. In farm, a farm is trying to decide two out of the four investments funds. From the past performance, they are able to calculate the following average return and the standard deviation of the funds. The current risk-free rate of interest is 9%, and both the average return, that is the market return from the fund, that is the return from the fund, better you can say return from the fund. If you see that alpha fund, Vinu fund, then Mina fund and Orbin fund, the returns are given as well as the standard deviations are given. Now what they are asking for? They are asking for Sharpe ratio, but if you look at the question, they have not asked what you have to calculate. They are asking for you have to calculate the return. By looking at the question, you have to understand which formula should be applied. Why? Because as the standard deviation is given and the return and risk return of the fund and risk free return is given, therefore these actually indicating you to use the Sharpe model, because Sharpe model we have to put the values for Rp, Rf and sigma p, and accordingly we have put all the values. Don't be nervous. The return from alpha fund 17, risk free return, look at for all the funds it is 9. Why? Because in the question, look at there, the risk free rate of interest 9% is given, and return from first fund is 17, second one is 18, third one is 16, last one is 14, and standard deviation of all the funds also given 19, 20, 30, 12. Accordingly we have calculated the risk adjusted return of the funds. Okay, also there is a way we can rank it. If somebody asked you which was the best one, which is the best one, then your answer will be Minu fund. Why? Because it is 0.53 among all the four, it generates a return of 0.538. okay, it was the, that's why in this way we can give ranking. Okay, now move on to the second one. Look at this question. The following information is given for blue chip fund, leading sector fund, contra fund, Rp, sigma p and beta. Now again I am telling, if nothing is given in the question, but here they were, if nothing is given, you have to calculate both the Sharpe and Treynor. Why? Because sigma, that formula will be applicable for Sharpe, and beta, that formula will be applicable for Treynor. Now again we are putting all those values, rp minus r, don't be nervous, very easy, rp minus r. Again look at the question, the risk free return is given, risk free return, risk free, look at the question, the risk free rate of interest is assumed to be 9%. Again in all the cases RF is 9 and the return from all the funds is given 25.38, 25.11, 25.01 and the sigma p is also given 4, 9.01 and 3.55 and accordingly they have calculated the return. Now they have done the ranking. It seems to be there is some mistake is there, 4.095 has been given as 1 but 4 point, instead of that 4.509 will be your 1 and 4.095 will be actually 2, but you should, going into that you should calculate it by your calculator. Simply the first one you should remember the return, suppose there are return from 10, 8 and 6, which will be ranking, you can give 10, suppose a student has got 10 out of 10, he will be 1, the students who has got 8 he will be ranked as 2, the last one will be automatically 3. Likewise you should calculate it and you should, this is not a very tougher one, once you understood the sum it is very easy to give ranking. The first, the maximum one will automatically get 1 and the least one will automatically get the least ranking. Likewise in case of Treynor ratio, look at there, everything is given, rp already I have discussed, rf also given, and if you look at the question, beta value is also given, beta value is given 0.23, 0.56, 0.59, just we are putting all those values and we have got the ranking. Now look at the ranking they have done in a correct way. 71 2.1, the maximum one, this is the best fund, so automatically if you got 71% return, automatically it will be your best one. Second one is 28.77 and the last one is 27.14. Now we move on to the next one. The following results are given, just balance fund, sigma p, beta is also given, and the small, and there are 3 fund, balance fund, small and mid cap fund, infra fund, nifty value is given and rf is given. Now very important thing was is there, nifty is given. Once nifty is given, if I ask you, that will be your rm, why? Because nifty indicates the return from the nifty itself. Okay, now the Jensen formula they have applied. Again Jensen formula I have already discussed, rp minus rf into alpha p plus beta into ra minus ra, and alpha p is actually indicates the managerial skills. The to properly adjust the adjust the Jensen measure for ranking purpose, each assets alpha should be divided by its beta. They have done this for the ranking purpose, but alpha is actually measuring the managerial ability or managerial. Now again very easy, rp for the first fund I am clarifying, what is rp? 25.3. what is risk free return? If anybody asks you what is risk free return, risk free return is 9. Why risk free return is 9? Somewhere it automatically given risk free return, yes, rf, look at the question, rf is given 9, rf is given 9, rf is given 9, rf is given 9, rf you have put rf, then sigma plus 0, beta value is also given. Look at the question, beta value for the first fund, the beta value is given, beta value is 0.23. then rm minus rf, rm means the return from the nifty, 36.74, and automatical alpha has been calculated. Then what they have done, alpha p by beta, the return is 43.48. in similarly in the mid cap fund also all the informations are given. If I ask you how many variables are there, rp, rf, alpha, beta, rm, 1 2 3 4 5, there are 5 variables is actually there. If you know the value of 4 variables, we can calculate the 5th variable. Likewise in the second case also the value of all the 4 variables is known to us, and we are known to us, and we have also calculated alpha p for the second one, 24.73. Look at 43.48 has been given as 1 and 24.73 has given as 2. And the last one, look at the last one, in the last one also all the values are given. Likewise, how many variables are there? 4. We have to calculate alpha, that is 30.29, that is 30.29, it will be automatically 3. Okay, now we so we have calculated today the return from Sharpe index, return from Treynor's index, return from Jensen index. Now another important sum, it sometimes give in the examination. Mr. Anand is having units in mutual fund for the past 3 years. He wants to evaluate its performance by comparing it to the market. Return 70.60. Look at the market. Return from fund is given, return from market is standard deviation. So many index are available in the market, it is given in the market. Market deviation is also given. Then risk free rate of return is given, risk free return. Next, beta is also given 1.12. One important thing, in the case of market, the beta is kept blank. But don't be nervous, you must write down the beta for market. Write down in your exercise book, it is always 1. What I am telling, beta for the market kept blank means it is always 1, and it cannot be a different value, it is always 1, it is always 1. Now move on to the sum. Now Sharpe index, look at the question. Sharpe index, very easy, everything we have done. Return from portfolio, return, risk free return is given, sigma portfolio is given, we have calculated. That is the very important thing you must remember. This is the Sharpe index for the fund, Sharpe index for the fund, Sharpe index for the, automatically Sharpe index for the market. Then what will be your calculation? Everything is also given for the Sharpe index for the market. If you look at the question, the Sharpe index for the market return is given 41.40, the risk free return is given 12, and the standard deviation is given 19.44. Again you go to back to the question and you can see over there in the video. In case of Treynor index, look at there, beta, same way. Again I am telling what they have done, listen very carefully. Sharpe in the first one is the Sharpe index for the fund, second one is Sharpe index for the market. Okay, next what they have drawn the conclusion, Sharpe index for the fund is lower than the market, and it indicates that the fund has not performed well. Very easy, because index is doing better than the fund, that's why fund have to perform better to attract more customer. In case of Treynor index also, we have calculated Treynor from the fund, Treynor index from the market, Treynor index from the fund. Market index means here it should be Treynor market index. Likewise Sharpe, we have calculated return from Treynor index from the fund, Treynor index from the market. Everything is again given. Return from the fund is given 70.60 minus 12, and instead of sigma it will be beta 1.12. And right now I have told you what will be the beta value for market. If nothing is given, it will be 1, that is 29.4. But in this case, in case of Treynor ratio, the fund is performing better than the market. Okay, and now the last one, it is very another important sub, generally comes in the examination. Pearl and Diamond are the two mutual funds. Pearl has a mean success of 0.15 and Diamond has 0.22. The Diamond has double the beta of Pearl funds, 1.5. The standard deviation of Pearl and Diamond funds are 15% and 21.43. The mean return of the market index is 12% and the standard deviation is 7. The risk-free rate is 8%. Compute the Jensen index, compute the Treynor and Sharpe index for the funds. Very easy. Now again we are doing in the same way. Look at here. RP, you don't bother the left one, rather you concentrate on the right hand side, what I have written in my own hand. RP minus RF plus alpha P plus beta into RM minus RF. RP we do not know. Now RF is 8 is given, alpha is value is not given, beta is 1.5 is given, and the risk beta, look at the beta, look at the question. The diamond has double the beta of pearl beta 1, automatically the pearl beta is 1.5. risk return risk from the market RM is 12, that is also given in the question. Look at the question. Market index is mean return, the mean return of the market index is 12, RF is 8, automatically RP came out as 14. Now if you look at the question, you find that if you look at the question, pearl has a mean success of 0.15. 0.15 means pearl has a mean success of 0.5, means that is the return from the portfolio 0.15, 15%. Now what is the difference between 15 and 14? That can be, look at here, that can be considered as the alpha, the predictive ability of the managers. That is, the predictive ability of the managers is creating that value addition in this fund. 15 minus 14, 15 minus 14, automatically it becomes 1. I am clarifying in a different way. Now listen carefully. If you put all the values in the left hand and right hand side, automatically it becomes same. Now look at here. Now RP, if we put it as 15, RF as 8, automatically it becomes 15 minus 8, 7. Now look at the right hand side, 12 minus 8, 4 into 1.5, 6. As we know equation, in case of equation, always left hand side will be equal to right hand side. What we have got in the left hand side? 7. Automatically the balance figure will be 1 on the right hand side. Why? Again I am telling, 15 minus 8 considered as 7. On the right hand side it is 6. To make it equal, automatically on the right hand side we have to put 1. So in this way you can also calculate. So predictive ability of the fund is 15 minus 14, that is 1. In the same way we can calculate the return for diamond fund. Okay, we have not done it, but it has been shown in the books, but you can do in the same way. RP minus RF equal to alpha P plus beta into RM minus RF. Again I am telling, what will be RM minus RF? 12 minus 8, and it should be multiplied by 3. Why it is 3? Look at the question. Diamond has double the beta of pearl fund 1.5. Okay, and RF will be 8. Automatically it becomes 22. It will become 22. Now if we deduct 20 from 22, why is 22? 20, it will automatically become 20. Sorry, the result came out as 20, and it is given as, look at the question, 0.22, that means 22. 22 minus 20, that too it is generated by the managers of those fund, that is alpha is 2. And the same way what I have already explained, in this case left hand side can be balanced on the right hand side, what I have already explained. And the Treynor ratio and Sharpe ratio I have not actually discussing, because several times I have already discussed about the Treynor index and the Sharpe index, all the values as given, and you have to just put it and you have to calculate all the values. Okay, assuming that you have understood the sum, and it concludes the discussion of the chapter portfolio evaluation, or the evaluation of risk adjusted returns of mutual funds. Thank you so much.